I think what's perhaps most striking is the lesson, not so much for policy, but for economic analysis, that the models that were used before the crisis neither predicted the crisis nor gave us a framework for responding to the crisis when it happened. And so in a sense, for an economist, this is a very exciting time because it means there's a lot of work to be done.
Inflation is an important policy target and continues to be, but it can't be the only one, the exclusive focus of central banks or somebody else who's, responsible for thinking about the stability of the system.
The simple dependence on conventional monetary policy, not to be abandoned, of course, but it seems to have come to its limits, and one has to move on either to direct fiscal policy or to innovative ways of dealing with money and credit.
Before the crisis, there was, in some circles, the view that fiscal policy was not as effective as monetary policy. And the notion that the only limitation to that would be when interest rates came down to zero, then monetary policy couldn't work. And that was thought to be a weird and almost never to occur circumstance. Well, we're now living in that very circumstance, and we're back in the situation where really fiscal policy does matter.
So basically the consensus was that a coordinated, drastic changes in fiscal policy right out the outset of the crisis did work.
But any aggressive fiscal policy would entail still a bigger buildup of debt, which will have to be settled in the longer run.
Finance is presumed to be at the service of the real economy, and it has taken off and served its own interests so that it's no longer linked to human beings or job creation, much less the impact on the environment or anything else. So that really has to be reined in.
The banking system has to become more stable. Regulation and supervision has to be improved, and central banks have to take the lesson that they should not provide any more excess liquidity, which might drive another asset price bubble.
We are never going to be able to design the most a regulation that will take care of every problem, but we should create incentives in such a way that the managers of the bank will be concerned to be prudent.
I think opinions differ on whether it is actually possible to supervise the behemoths of the global financial system, whether they are not only too big to fail, but too big to supervise because of the enormous amount of political power, financial power that they possess. So I think one reason that people have not grasped the nettle of improving supervision is nobody quite knows what the fixes are.
We have lots of ideas for how to create balanced growth worldwide, but most of those ideas actually involve, in one sense or another, constraining the appetites and the political power of the rich, and it is unclear whether or not we'll be able to do that. And if we don't do that, we are absolutely certain, A, not to have balanced growth, B, to continue high unemployment as we've had it, and C, to repeat our cycles of financial bubbles and busts.
I imagine we'll muddle through, but maybe we won't, and we'll have a kind of mini crisis either in Europe or America or both. But beyond that, I think what's going to happen is that the growth will sort of struggle back, but the employment problem will remain.
Thank you.